Okay, peeps, welcome back. So today we're going to be talking about 5 dividend growth stocks that are deeply discounted to buy right now. Let's get it. So the first stock that I'm sure you guys have noticed would be Realty Income. So what is Realty Income? They're basically a real estate company that has, I believe, a lot of corporate partnerships. They have partnerships with different grocery stores and food chains and like fitness centers and stuff like that. So they're kind of a big, I don't necessarily want to say commercial investor, but they have properties that they lease out and stuff to these different companies that operate out of these buildings. So as you can see from the top here, we have had a massive, massive pullback since the pandemic. How big of a pullback is this? Well, this is roughly about, I would say about 33%. If we move in here a little bit, you guys will have to excuse me. I have the chart up on the left because I'm actually in a trade right now. But if we kind of zoom in a little bit here, you can see that from this top wick up here to roughly around the current price, getting about a 32-ish, 33% discount. These used to be as high as $82 a share. Now they're only currently $55 a share. And as we've told you guys before, or those of you that invest in dividend paying stocks, you know how this works. The lower the prices, the higher the yield is, and the higher the prices, the lower the yield is. So it's always a better time to buy stocks or ETFs that pay dividends when they're at a discount. Usually that's the time that you would be able to boost your passive income, along with the dividend capture strategy. You can check that out on our channel if you haven't, if you want to. So this is the Realty Income Corporation's common stock dividend page on the NASDAQ. So the ticker symbol is O. That's literally just an O, not a zero. So the dividend yield is 5.6% currently. Keep in mind, if the price does go back up to $80 a share, which I don't think it's going to in the immediate short term, this yield could possibly go down and it would be more expensive to buy shares. So the current annual dividend is $3.07 per share. As you guys can see, they recently just had a dividend payout here, or a dividend increase for the payout here in actually just a couple of months ago, it looks like. So you guys can take a look at the history here on the overall dividend payout schedule that they have. They've literally been raising their dividend for eons now. You can see it looks like the last time they had a cut was all the way back in 2004. So that was probably shortly after the dot-com bust, although that may be a stock split too, or reverse stock split. Not really sure, but you guys can see basically since 2005, if I scroll up here real slow and you just take like a bird's eye view at the amount of dividends you'll get per share, it has constantly increased basically since then. So you're talking probably over 2 decades at this point. And the 5 stocks that I picked for y'all today are diversified. Just so you know, they are in the real estate sector, the how do I want to explain this? The home and care or discretionary sector, grocery store sector or retail. The other one would be banking, and then you also have electricity, and we have an honorable mention as well. So we'll get into that in a minute. So that would be the first one. The second one that we're going to take a look at is actually the home and care one, which is Clorox company. As you guys know, they make like bleach and all kinds of different products that pretty much everybody uses in their everyday lives at home. Pretty much cleaning supplies. I mean, it's more or less what they do. So you guys can see from the drawdown all the way back in July of 2020, shortly after the pandemic started, we've had roughly about a 41% drop in the share price, which is a huge drop. I mean, this thing used to be $240 a share. Now it's only $141 a share. So you're getting nearly a 50% discount on the stock. So let's take a look at the dividend here. So you just type in ticker symbol CLX on the NASDAQ and you'll be able to find this. You can see the current yield is 3.4%. So I think it's fair to assume if it went up 40%, the yield would be like maybe slightly under 2%. So not that great, but with it being at a discount, the idea is it's not just that the yield goes up, it's also that you're increasing your income for less money. That's kind of the idea here. So you can see based on the history here that the last time that they raised their dividend was basically back in 2000. So this company's been raising its dividend for nearly 25 years, and dividend aristocrats have to have raised their dividend uninterrupted without a cut for at least 25 years. So this one's pretty close. You get a dollar 20 a share, which again is not much, but you are getting the increases in payouts over time, as you can see. Um, what was I going to say? So the other thing I wanted to point out about O Realty before I get into the next stock is the reason why the share price is so cheap on O Realty. So if we go back to it, the reason why it's been beat down so hard, it's not just because of the pandemic, in my opinion, but it's also because of the fact that the Fed's been raising rates. They started raising rates like roughly in this area, March, April timeframe, and ever since then they've been dumping off a cliff. So to understand this, you have to understand the macroeconomics of the markets. So basically, when the Fed raises rates, it causes mortgage rates to become more expensive. Um, the cost of borrowing in general becomes more expensive, whether it be commercial real estate, residential real estate, auto loans, personal loans, credit cards, lines of credit. Especially if you're going through a bank, it becomes very expensive to borrow. So that kind of puts downward pressure on real estate or REITs in this case, whenever the Fed funds rate is raised. So when the Fed funds rate gets cut and when it goes lower, these prices should, in theory, go back up. So with that being said, we're going to go to stock number 3, which is Kroger. I'm sure you guys have all heard of this. They're pretty much all over the United States. But as you guys can see here, since basically since pretty much the start of the bear market last year, we've had a massive drop on this thing. It's dropped roughly about 28%. It used to be $62 a share. Now it's only 45 roughly, just 28% discount. I'd say that's pretty good. So we're going to take a look at the dividend here. We get Kroger, ticker symbol KR. You can see the yield currently is 2.5%. So obviously without the massive discount on the stock price, it would be a much lower yield. So definitely something to consider and perhaps take advantage of while the prices are low. Not financial advice, but you guys can see that basically they have been raising their dividends since 2006. It looks like they went like 20 years without paying a dividend. I'm not sure what that's about, but yeah, I mean, they've had a dividend raise for eons now at this point. As you guys can see, something kind of strange happened back here. I'm not sure what that was, but they have more or less consistently over time raised their dividends. And as you guys can see, they just recently had a dividend raise this last quarter. So overall, a pretty good company. They're a large company. I mean, Kroger owns like Fred Meyer's, and I don't even know how many different accounts they have, but it's like a lot. I think the amount of employees that works for Kroger is almost 1 million. It's pretty much like a competitor to Amazon and Walmart. So very big, well-established company. So the next stock would be Ally Financial. Now, I had to decide between Bank of America and Ally Financial. In this case, I think they're both great picks. But Ally Financial has actually a slightly bigger discount. So you can see here that Ally Financial is down 46%, as where Bank of America is down roughly about 38%. So, I mean, pick your poison, whichever one you think is better. Bank of America is a bigger bank. But a 46% discount is pretty huge. I mean, that's hard to beat. So this thing was at $56 at the peak. Now it's currently at $30. And if we take a look at the dividend itself here, you guys can see that it currently yields a 4% dividend. So that's pretty much on par with inflation. But keep in mind, you're also going to get the price appreciation and the dividend raises that come along with the stock. So something to keep in mind. It looks like they haven't raised their dividend in a couple of years. But again, remember, banks and real estate tend to suffer the most when the Fed raises rates. That's just typically how it works. But they have not cut their dividend, which is good. They have raised it for quite some time. So it's pretty much been raised since 2016 from the look of it. And you get $1.20 share, which is pretty good for a $30 stock. But if you wanted to go with a little bit more stability and you're like, yeah, okay, Ally Financial, whatever. Give me something that has a better history. You can pretty much take a look at Bank of America. They've been raising their dividends since 2014. So September of 2014, they have been raising it since then. So that's almost an entire decade at this point. You still get a pretty decent amount. I mean, almost $1 in annual dividends for a 30 some dollar stock. So that would be the banking sector. And then the last one here that we're going to take a look at is American Electric Power. And something I want to bring up to you guys is this is actually all 5 of these stocks. We used to actually own all 5 of these stocks in our portfolio. This was last year and in 2021 before we went to dividend income stocks. So we can personally attest to these stocks. We did actually hold them at one point. We can go back. We'll go back in our dividend portfolio at a later video and show you guys so you can see for yourself. But from the peak here on AEP, you're having roughly about a 24% discount. It was $105. Now it's only $80. And this is for electricity. For those of you guys who know, obviously utilities have to be paid in commercial and real estate buildings. Doesn't matter if you have a house, apartment, you have a condo, whatever, you got to pay electricity, right? So why not get paid to actually invest in companies that create the electricity? So with that being said, we'll take a look at the dividend history here. You can see that it is outpacing current inflation at 4.37%. You get $3.52 a year per share, which is pretty good. And you guys can see that the dividend history has been going pretty strong for a long time here. It looks like the very first time they raised their dividend was in 2005. So this company is almost 20 years in the making in terms of dividend raises. So that's a good, strong history, I would say. So anyways, this is the 5 dividend growth stocks that are deeply discounted to buy right now. Let me know what y'all think. If you have any suggestions for another video, like particular stocks that you want us to talk about, whether they be growth stocks or income stocks, let us know below. Please like and subscribe, and we'll see y'all later. Peace.